Hello and welcome to episode 454 of the Money to the Masses podcast with your resident expert, as always, Damien Fay, and me, Andy Leaks. Damien, welcome back. How are you doing?
Yes, I'm good, Andy. No doubt, as people are listening to this on Easter Sunday, I'm probably stuck on the M25 with everybody else, trying to make my way round to different family members. So, yeah, I'm all good, Andy, but I'm probably not, as people are listening to this, I'm probably moaning about the traffic.
Yeah, that feels a little unfair, actually, because I know how hard you've worked all week leading up to the Easter weekend, and all you really want to be able to do is just sit down on the sofa. Still, a long sit down on the M25 is as good as a rest.
It is as good as a rest. That's how I should see it. And of course, I'm always normally talking about having to do the gardening. I'm still trying to get out into the garden. The weather's been terrible. So I'm not sure if that's a good or a bad thing, because I'm not the keenest of gardeners. But anyway, moving on to what's going to be on this week's podcast. Now, we are moving to the business end of the tax year. And so Andy and I have been involved in producing a video for our YouTube channel called the Best Stocks and Shares ISA. So we've done a video that we're going to be bringing the highlights from. So we're going to actually play out the lion's share of that video on the podcast, but I'll explain more in a moment. The other piece on the podcast I'm going to be doing is an investment piece. So this is a piece that's been inspired by a piece of research for 80/20 investor members. And people who've been long-time listeners may remember that I created the perfect ISA portfolio. So the aim being that this portfolio outpaced the FTSE 100 over the period since ISAs have been in existence. So basically going back to 2000. I actually took it from April 2000. Technically ISAs have been in existence just before that, and it had to never have lost money in a given tax year. So I'm updating this piece of research for the first time in a few years. So how has it done? Is it still working? And the final piece we're going to be doing on the podcast, Andy, you're going to be talking about energy.
Yeah, that's right. I'm going to be talking about a specific smart tariff, and one of the key features of that tariff involves something called plunge pricing. Stand by for that, because you can get paid for using electricity. So that's an interesting piece, and we'll do that at the end of the pod.
Yeah, so that's hit the headlines this week, and there've been a lot of people talking about it because it is something where we now have the evidence to support the fact that you can get paid, something we've never talked about before on the podcast. So it is incredibly interesting. I'm going to kick off with the 80/20 investment piece, actually. So the perfect ISA portfolio was something that I created a number of years ago, actually. It was about 7 years ago when I first created the piece of research. And the portfolio worked on the idea, could you have created a portfolio that had a fixed asset allocation, so it never changed over time? And could it have produced a positive return in every tax year since the year 2000? And could it have also outpaced the FTSE 100? Now, that's quite a bold, aggressive set of criteria. And I actually created this portfolio when I did the original research back in 2015. So that's 9 years ago. And one of the great things about when you do some research and you sort of play about with an idea and you never quite know whether you're going to be able to come up with something, is that when you do, and then you let it run into the future. So I created that back in 2015, and each year thereafter, I'd go back and look and see how it was doing. And the last time I looked at it was back in 2021. So I'd done a complete tax year. And so that was a few years ago now. And every year since I'd created the portfolio, it had achieved the same feat that I'd wanted to at the beginning. So it continues to produce positive returns. It continued to outpace the FTSE 100 over the long term, not necessarily in each individual tax year, but over the long term. The asset mix had remained the same and hadn't changed. It's very simple to implement. So what I've done is updated the research and gone back and looked to see how it's done in the last couple of years. And now there's been a couple of tricky years in the investment world. And so we've had 2021 at the end, when we started to see rates going up and inflation started hitting the UK economy and also the global economy. But then we had 2022 as well, which was a very difficult year for investments. If you remember, it was a once in a century style event. It was a black swan event really for bond markets. So it's the worst year in the century for bond markets generally, and also equity markets struggled as well. So just to remind people, and I can't remember if I've actually explained the asset mix, but I'm going to give it away anyway on the podcast. The perfect ISA portfolio always had an asset mix that was 9% cash, 71% UK gilts, and 20% UK equity income. So the way it worked is you had to be able to pick any fund within those sectors. So to produce the return, I looked at the average return for a fund within those sectors. And when I created the original portfolio, I looked at 27 different unit trust sectors out there and looked at all the permutations that I could create to see what would be the best allocation. So there was no constraint in that regard. And it actually boiled down to those three different assets in that combination that I mentioned. And so going into 2020, the perfect portfolio made 2.5%. So again, it was in positive territory. But 2021, unfortunately, the portfolio lost 2.25%. And then we had 2022 came along and it lost 10%. And so that felt like that was the end for the perfect portfolio. We actually had a scenario where it finally lost money after more than 20 years in a given tax year. Of course, it was still massively up in profit, and it had actually started to underperform the FTSE 100, because over that period, the FTSE 100 was up 183%, while the perfect portfolio was actually up 108%. So the last 2 years, it's seen a decline. And the reason for that decline was because gilts got hammered. So anybody who listens to our market updates or follows 80/20 Investor, or they've been listening to the podcast generally, will know about gilts getting hammered as rates went up. So when you have rates going up, or the expectations of them going up, you start to get long duration assets impacted more aggressively. So in the bond world, that long duration means those that are most sensitive to interest rate movements. So gilts, generally speaking, are long duration bonds. So they are impacted more aggressively than shorter duration bonds, for example, when interest rates go up. And so what we saw were gilts plummet in 2022. And if you look at the numbers, the average gilt fund fell around 14.78%. So there was a range of variations within that, but every gilt fund lost money. So 2022 was one of those years where it was almost impossible to make money. The only way you would have done it if you'd bought a couple of specific asset classes, and one of them included gold. So there's a hint there in maybe how you can improve the perfect ISA portfolio. So what I've done is, for 80/20 Investor members, is looked at the portfolio and said, well, why didn't it make money in those 2 years? And then try to see if it could be improved. I mean, I could have just moved the goalpost, changed the criteria that it had to meet. But having looked at history, 2022 was one of those bizarre once in a lifetime events. And so trying to make something that could beat a black swan event, something that you could never really predict would happen, is almost impossible. So the lesson from that is that you almost can't. And it's one of those strange things that as I went back and I started to look at the various different asset classes, and I actually included a whole bunch of new ones. So I started to look at over 30 different sectors and try to include them to see were there other assets that we could have included in the original portfolio that would have made it, therefore, have a positive outcome in 2021 and 2022. And it's one of those things that as you started to tweak a portfolio and include different assets, then you might make it have a positive return in 2022 with the benefit of hindsight, but then something would pop out in 2008 when we had the financial crisis and the portfolio would have lost money then. So it's almost one of those strange things. You're trying to contain it, and then you'd make 2022 okay, but then 2008 would suddenly have ended up in negative territory. And the outcome of it, really, when you look at the research, is that it's pretty much impossible to have had a portfolio that had a fixed allocation that would not have made a negative return in a given tax year. Now, yes, I could have changed it so it wasn't tax years. Maybe we could have gone to calendar years. But the point is, I couldn't have made it really work. And that's because we had a financial crisis and that 2022 event where we saw interest rates go up aggressively and bond markets collapse. But there are lessons to be learned from this, because I did make some tweaks. I'm not going to give the new revised perfect portfolio that I've created since with the benefit of hindsight. And now that portfolio doesn't in fact create a positive return in every tax year. There are 2 years where it doesn't, and one of them is 2022 and the other one is actually 2013. But the losses are only 1.5% and 0.6% in those 2 years that I've mentioned respectively. So it's actually more manageable. So you've actually reduced the levels of any downside. But the way it worked was I ended up having to include gold. So the problem with a bond equity portfolio, in the case I had, was equities and gilts, is that it's only two assets that are trying to negatively correlate to each other. And of course, we had a period where they became positively correlated. They moved up together and down together. Well, that was the problem that we had in 2022. Yes, my portfolio had a bit of cash in it, so that was a third asset. But introducing gold was the key to actually making it work. And it's something that happened during 2022 with my own 50k portfolio. The reasons that I was able to outperform the benchmarks was because I had other assets like gold in my portfolio that performed particularly well. But the other thing was that the way to improve the portfolio was ultimately to diversify it in a much bigger way. So we needed to diversify not only globally, but also when we looked at the low risk portion, so the gilt part, which historically was all you needed to achieve what I had tried to with the positive returns in each tax year. You needed to have a range of exposure in that part, not only globally, so have some global bonds as well as a little bit of gilt, but also looking at things like strategic bonds, which tended to have a lower duration as managers started to shorten their duration. And during 2022, it limited the downside. So there are lessons from this whole perfect ISA portfolio. It finally broke, as it were. This tax year, it's back into positive territory. So maybe it could have some resurgence, and in the long run, it could get back to winning ways and only have had a little bit of a blip because of that black swan event. But the message really was a lesson that we've known all along, that you have to be flexible. You do need to look at how markets are responding, what's going on in the environment, and actually just being wedded to one allocation with a very limited number of assets in it or types will ultimately cost you at some point if you get the event that does hamper those particular assets. So when it comes to low risk assets, it does mean have things like cash, have gold, have bonds, corporate bonds, gilts, various duration, and also globally diversified. So you're not just diversifying your equity exposure, you need to do your bond exposure as well, the low risk part of your portfolio. And people who are interested can go and see the new mix, which is obviously outperforms over the long term the old perfect ISA portfolio. It doesn't quite catch up with the FTSE 100 over the long term and almost is perfect in each tax year. But the lesson really is you can't really be an investment if the downside is all you're worried about. So if you're only worried about losing money, then ultimately you end up constraining what you can do, and eventually you constrain the upside. So even the perfect ISA portfolio, it was a nice idea. It was something that had a good journey, but like everything, it's just a good example of where past performance doesn't guarantee it in the future, even though it had such a good run. But you can tweak it. And it's, again, diversification is always the key to any of this.
Okay, so let's move on to the best stocks and shares ISAs in 2024. Now, Damon, you're going to explain how this piece works, because we've been working hard on this and we've produced a brilliant video that's going to be on our YouTube channel.
Yeah, so the video was in response to people's requests about the best stocks and shares ISAs. So we have articles on the website where we cover this and look at lots of different things. And in the video you're about to hear, you're going to hear the audio. So all of it won't quite work on terms of podcasts. What we're going to do is put a link in the notes of this podcast. You can go through and find all the articles that we reference in the notes of the YouTube video. We aren't going to give you the whole video because there are parts we're going to just take out, because we do cover platforms in terms of the best if you want to have a managed ISA, which will be in this audio now. We also cover trading. We also look at buy and hold type of investors, which platforms might be best for you. We also look at ones where they give you the best return on uninvested cash. We won't include that on this part of the podcast, but the video has it. So the key thing is this is a good roundup. We're at the business end of the tax year. There'll be a lot of people listening to the podcast who may be thinking about investing or looking for a platform. And more importantly, now you can start to have more than one stocks and shares ISA in the new tax year, so from April 2024. So listen to this. You may be somebody who has a portfolio with Vanguard, but you can't buy shares through Vanguard Investor, but you may start thinking, I want to actually regularly invest money in a portfolio that I can buy US shares. So you can contribute to a stocks and shares ISA with Vanguard in the new tax year, but also with another provider that is very good for trading, very cost effective. Then this piece will be of interest to you. So as I say, the full video you can find via the link on the show notes. There are plenty of things like the performance for managed ISAs that we talk about that you will need to see the video to find the link to go to the article on the Money to Masses website. It all makes sense if you click on that link. We'll meet you on the other side of the piece. Andy's going to play it out now for us. In this video, I'm going to be talking through the best stocks and shares ISAs of 2024. Now, the thing is, there is no one answer for everybody. So any video that you watch where they tell you this is the best stocks and shares ISA, I think doing a slight disservice, because the thing you've got to bear in mind is that for different people, different stocks and shares ISAs will be better than others. So you've got to take into a whole range of factors, and they include things like fees and charges. Of course, they are among the most important, but there are things like customer service, the performance of a portfolio if you're buying a managed ISA, although that is no guarantee of future returns. There is, of course, the investment options that exist? Do they offer things like other products like ISAs, for example? Do they offer a managed ISA if that's what you're after? Do they offer an app? So there are plenty of people that want an app to be able to run their money. There are plenty of platforms that don't have an app, or if they do, the app is pretty basic and you can only use it as a read-only type of service. Do they give any decent interest on cash? So do they pay you, for example, if you have uninvested cash sitting on their platform, do they give you any interest? And if so, how much? There's a big disparity, and I'm going to come on to that later. Also, there may be additional features and tools, and the range of investments in terms of ETFs, maybe US shares, maybe it's just you're after unit trusts. What type of investments do the platforms offer? There's a whole range of things that go into that melting pot that mean that one stocks and shares ISA is not best for everybody. And at the end of the video, I'll go and explain why you don't have to just pick one. And it's a very important point. So what I'm going to do is put a load of links in the notes of this video that go through to the Money to the Masses website that do a whole range of comparisons. There are reviews of every product that I mentioned in this video. You can find an in-depth review analysis of the products, the services, costs. So make sure you go through to those. But also there are versus articles where we compare platforms, stocks and shares ISAs side by side. So you can see whether, for example, Vanguard might be more cost effective than using Interactive Investor if you're investing in Vanguard funds, for example. I'll give you a clue. Actually, it's not universally. So there's a certain point where Interactive Investor gets cheaper, but I'm kind of getting ahead of myself there. So what I'm going to do is start off with different scenarios in terms of maybe the best managed ISA, the best ISA if you want just to buy and hold, the best ISA if you want to maybe trade shares. So maybe you want to buy and sell US shares. I'm going to also talk about the best ISAs for those who have uninvested cash. So I'm going to cover a whole range of those, and I'm going to go through each in detail. Do pause the video. If you find it useful, hit that like button, but also subscribe to the channel. So I'm going to start obviously with the caveat that obviously if you're investing your capital is at risk, so do bear that in mind. And really, stocks and shares ISAs are only really of use to you, or should be used, if you are investing for at least 5 years. If you're not, and you want access to the money before that, then you should be really looking at a cash ISA. But I'm going to give you some highlights of the best platforms out there. So if we're talking about managed portfolios, these are for people who don't want to run their own money. They just want to focus on investing money, contributing to a stocks and shares ISA, and somebody else doing the running selection of the investments for them. So there are three, what they would used to call, I suppose, robo-advisors, but think of them as managed ISAs out there that probably stand out. And they are, first of all, Wealthify. So if you've got £50,000 or less, then they may be of interest. So firstly, they only offer managed portfolios, and there's 5 risk-rated portfolios that they have. They do ethical versions, so those are versions of the main portfolios, which are obviously having a range of risk, but they have a more socially responsible tilt to them. You can invest from as little as £1, which is quite attractive for new investors. This is very low. So Nutmeg and Money Farm, which are competitors in this space, you have to have at least £500 as a minimum investment if you wanted to start investing with them. So an attraction of Wealthify is that that charging structure is very simple. Now, when you have a platform, so we're talking about stocks and shares ISA, that platform that runs it will charge a fee, which is called a management fee or annual management fee. It's 0.6% across the board, irrespective of portfolio size when you're looking at Wealthify. Usually things are tiered in different platforms. This one has a very simple charging structure. There's always an underlying investment charge. So that's the underlying ETF or fund that you buy with, well, that's regardless of whatever platform you choose. So it is one of the cheapest ways to invest if you're starting out, particularly if you have less than £50,000 in your portfolio. Now, those portfolios that they do offer are managed, which means that they can change the asset mix, so what assets they invest in, whether it be UK equities, European equities, or whatever assets that they choose. They don't offer simple fixed allocation models, so those are static, and they often are much cheaper when providers provide those. So if you want something like that, then you might be wanting to look at someone like Money Farm. Those fixed allocation models where the allocation is static, they are relatively cheap. They charge between 0.25 and 0.45 for the annual management fee. Again, there's always an underlying charge, which is obviously relatively small, but there is a charge for underlying investments. That's the same across the board of any platform. The fully managed portfolio is a little bit more expensive, 0.35% a year to 0.75%. One thing I would say about Money Farm, which I do quite like, is that the more you invest, they actually can get cheaper. So by that, I mean that normally with a tiered structure, so if you invest a small money with a platform, the part that may be above £50,000 may be charged at a lower rate than the stuff below that. But with Money Farm, once you go across those tiers, everything gets charged at the new reduced rate. That is slightly different, and I do quite like it. Now, Money Farm also offers something called thematic investing, where that is a portfolio, but it has a tilt to a theme. Now, they have a number of themes. One of them includes exposure to AI, so artificial intelligence. That will be attractive to some people. So these are quite interesting for people who don't want to run their own money. They just want to concentrate on putting money into their stocks and shares ISA, but they want it maybe managed by somebody else, so they can do that. But they may have a view where they may say, I want exposure to AI. They might think that's the future. So you can do that with Money Farm. They also have just started to introduce a limited range of stocks and bonds and ETFs and mutual funds that you can buy, but that isn't really their forte. Moving on to Nutmeg. Now, Nutmeg are a provider that have a much wider range of portfolios. So these portfolio ranges have grown over time. They've got 10 risk-rated portfolios, which is the largest range of the 3 providers I've already mentioned in this section. They also have other managed types of ISAs. You can have ethical ISAs. They have a range of ISAs that are provided by JP Morgan Asset Management called Smart Alpha Portfolios. Do check the review that we linked to. It gives you all the details about the different portfolios that you can have. They also offer a lifetime ISA. I know I'm talking about stocks and shares ISAs, but you just need to bear in mind that if you want all your investments in one place, then you might want to look at what else platforms offer. So do they offer a pension, for example, or a lifetime ISA? But that is down to you. Now, like Money Farm and Nutmeg, they do allow you to invest in those socially responsible portfolios. And Nutmeg also offers thematic investing, a bit like Money Farm does. So you can, for example, have a technological innovation tilt to a portfolio, or something that's to do with the evolving consumer. Again, links in the notes you can go to and look at that at your own time. Now, of course, talking about managed ISA portfolios wouldn't be complete if we didn't mention performance. Now, you should never pick something just based on performance, because past performance is no guide to future returns. But we have actually done the analysis on the best performing ISAs out there, the managed ones, and we've looked at a range of them. Money Farm, Wealthify, Nutmeg, for example, the Vanguard Life Strategy funds that are also out there, and we've compared them. So we do update these regularly, and we look at the performance in each year of the last 5, because the good news is that now many of them have a history of performance. Vanguard have actually launched a managed ISA. It's different to the Vanguard Life Strategy funds. I've actually been shown the portfolio of the managed ISA versus the Life Strategy funds. I can confirm they are different, but of course there is no history that you can really go back and look at in the new service, but that is your choice and up to you. We do compare them, we do update this regularly, so make sure you click through to that article if you are interested. But as I say, there's not a reason just to pick something based on performance, because there's no guide to the future returns that you will get. Now, moving on to the cheapest, if you just want to buy and hold a portfolio of funds that you choose yourself. So you're not having a managed portfolio, you're choosing what you want. Now, the thing is, which is cheapest depends on what you want to hold. So whether that's ETFs, in the case of holding a portfolio of ETFs, then you'd want to look at an Invest Engine, because they don't charge a platform fee and you just pay the charge of the underlying ETF that you choose. Now, the limitation, of course, is that you can only invest in ETFs with them, but they are very cost effective, and there is a selection of over 600 ETFs. Again, links in the notes to a full review of that product where you can find out all about them. One thing to mention in this video is that lots of platforms have offers, and we list those as well. So we're talking about things like cashback offers, or offers if you transfer money across to them. So an existing portfolio, then you can also get maybe a cashback lump sum as well. So do bear that in mind if you're making a choice. You shouldn't just choose it on cashback, but it's something to bear in mind. Now, a section on buy and hold wouldn't be complete without a mention of Vanguard. So Vanguard is pretty much the darling of the internet when it comes to investing. Now, they have a range of ETFs. They have the Life Strategy funds, which are incredibly popular. They're a diversified portfolio of equity and bonds. They're globally diversified. Now, they have a platform called Vanguard Investor through which you can buy all of these different investments. The one drawback is that you can only buy Vanguard funds. That might not be a problem for you. And also, they don't have an app at the moment. That is meant to be coming in the future, but if you really want one now, then you might have to wait a bit. Now, the positive with Vanguard investors, of course, it is very cost effective. They only charge 0.15% as a platform fee that's capped at £375 a year. Of course, as always, you've got to pay the underlying charge of the funds that you invest in, but again, they are very cost effective. So Vanguard investor is one to look at. Now, the one thing I will point out, though, that if you are a Vanguard fan and you maybe love the Vanguard Life Strategy funds, there can be a cheaper way to hold those if you're not planning on buying and selling. So if you go with Interactive Investor, so II, then we'll put a link again in the notes. They are cheaper to buy and invest and hold Vanguard Life Strategy funds, for example, if you have over £96,000 in your ISA portfolio. So the more you have, the cheaper it actually becomes because of their fixed fee. Now, there is a bit of a weird quirk with their charging there. There is a sweet spot between 48,000 and 50,000 where they can be cheaper than Vanguard Investor as well. I'm not going to get into that. Rule of thumb, above £96,000, then II starts to come into play, even if you have a slight obsession with Vanguard funds. Now, going on to Interactive Investor or II, they are an attractive proposition for people who are wanting to buy and hold because they have a fixed fee model, which means they charge a monthly amount, typically $4.99 or $11.99, depending on the amount that you have to invest. They have a wide range of investments, ETFs, investment trusts, unit trusts, shares. So they are an incredibly popular platform. As I say, the more you have, the more cost effective they are because they don't charge a percentage fee of your portfolio as a administration charge. They actually just charge that fixed fee. One thing to point out, that fee does come out of your bank account separately, so bear that in mind. We can't not mention AJ Bell in this because AJ Bell, if you're not buying and selling, a bit like Interactive Investor, where they charge for you to buy and sell shares, for example, they are very cheap if you don't, and they have a fee, an annual charge of 0.25%, which reduces to 0.1% if you have over £250,000, and anything over £500,000, there isn't a charge on that part of the portfolio. So interestingly, while there is a 0.25% fee for holding shares, investment trusts and ETFs, it is capped at £42 a year. The final one I want to mention in this section, and again, this isn't a complete list. There are going to be people who may like other platforms and they can be more cost effective in other scenarios. Interactive brokers won't be well known to quite a few people in the UK. They have a complex charging structure and they aren't I think, my own personal opinion, the most user-friendly platform out there. But if you want to buy and hold, then they are very cost effective if you want to buy and hold certain things like shares and ETFs. However, they do charge FX fees when buying shares and ETFs, as well as a minimum monthly fee of £3. So they are good value. Now, I'm going to move on now to if you want to have a stocks and shares ISA for trading. So a standout one is Trading 212, and they don't charge a platform fee or a subscription fee, and it offers a wide range of stocks as well as ETFs. Now, it doesn't charge commission, so there's no commission fee for buying and selling shares. However, you will pay a foreign exchange fee of 0.15% when you buy or sell US shares. That actually compares very favourably, say, with free trade, for example. But again, if you're in this world where you like to have things in one place and you want to have a pension, Trading 212 don't offer a pension, but we are talking about stocks and shares ISAs here. If you did want one, something like Trading 212, free trade do offer a pension. Now, if you are thinking of trading, I'll mention Invest Engine. They don't offer shares, but obviously if you're thinking of buying and selling ETFs, then again, following what I said earlier, they are cost effective. Again, you've got to mention interactive brokers in this section. Yes, it's complex charging structure, but it can be cost effective. There are details in the link to our full review. Now, moving on to cash. Now, okay, if you want to hold cash in an ISA, you are better off a cash ISA. There are better rates out there. But stocks and shares ISAs have started to pay a better rate of return on cash, so better interest. Now, you can get 4.45% from Best Invest, for example. Now, Best Invest have always been one of the leaders in terms of the amount of interest they pay on uninvested cash. Yes, you will probably be looking to invest that money because that's why you've got a stocks and shares ISA, but there's nothing wrong with getting a decent rate of return on the cash when it is uninvested. Others to bear in mind that pay a pretty decent rate, Fidelity and also Hargreaves Lansdown aren't too bad. Now, if you're looking at something like free trade, so you're looking at trading, they do actually pay a pretty decent rate of return. They pay 5% interest at the moment on cash that's uninvested up to £3,000, that is. So it's not a free for all, but you do get some return on a limited amount of cash. Now, one thing to bear in mind when we talk about the return on cash, that's what we're exactly talking about, not money market funds. So there are lots of platforms that don't give a return on any cash that's uninvested. Instead, they promote their money market funds. They aren't cash, they're cash-like. So it's not that. Now, one thing, we are in a world now, we're moving into 2024 and there's been a change in rules. Before I come on to that, the first thing I want to point out is that just because you have a platform, you don't have to stay with it. As you will probably have seen now, there's quite a range of differences in terms of costs and the things that you can do on different platforms. You can move your money, it is yours. So you can transfer your portfolio, if you've got an ISA portfolio, across to a new provider, or if you've got an existing portfolio, there's no reason why you can't open a stocks and shares ISA with another provider. Now, from April 2024, the rules have improved for consumers, so you can actually open more than one stocks and shares ISA in a tax year and contribute to them both. Now, why that's interesting is you may, for example, be a big fan of Vanguard and may have a portfolio of Vanguard funds with Vanguard Investor or Interactive Investor, but you decide that you might want to top up that portfolio, but at the same time you might think, I want to do a bit of trading, but I can't do that on Vanguard, or it's more cost effective than Interactive Investor if I use Trading 212, for example, or something very similar. So you could put some money into your ISA with Trading 212 to trade with, but also put some money in the same tax year into your portfolio that you've got with an existing provider or another one that you've just taken out. So there is this choice. Make sure that you use it. So do shop around. You can open up more than one. There are plenty of really good offers as well. I've mentioned cashback offers. That isn't a reason to take out a platform, but if you're thinking of taking one, do look out for them. We put a link in the notes of this video with a roundup of all the best offers that exist. They regularly change, new ones come, existing ones get pulled, so make sure you do check out that link.
So there we are. Make sure you do check out that video on YouTube because it's got all of the resources that you need. You just need to click on those links and it will take you through to the relevant reviews and the performance data. So Damien, moving on to the next piece.
So yeah, Andy, we're going to move on to the final piece, which is relation to energy. And this is because news hit the headlines because there were numbers now that it could be shown that tariffs, or a tariff that allows you to be paid for taking energy from the grid, so basically using appliances at home, actually works. And there's some numbers now. And this is in relation to something called plunge pricing, which I know lots of podcast listeners will never have heard of. When you explained it to me and we're chatting before the podcast, I was fascinated by it, especially in the world of technology now, where it's easier to alter our usage to be able to take advantage of changes and fluctuations in energy prices.
Yeah, so Octopus Energy is the only provider that gives you access to what you've described there, Damien, plunge pricing. And actually, there's only one specific tariff that offers it at the moment, and that is the Agile Octopus tariff. Now, I've done a full review of that tariff, and we put it in the details of the show notes so you can take a look at the details of the tariff in full. Essentially, it's a smart tariff that allows you via a smart meter to access wholesale energy prices, which are updated, and this is crucial, every 30 minutes. Now, there are quite a few tracker type tariffs out there that track wholesale energy prices, and they could be good value for some, but they only track the energy prices on a daily basis. But the Agile Octopus Energy Tariff tracks it every 30 minutes, which makes it really interesting because it uses the latest smart technology, which means in this new world of electric vehicles and smart devices, you can start to program these things to access energy at its cheapest level. So then just briefly explaining what plunge pricing is, it's a system that allows you to effectively get paid for taking the excess energy off of the grid. In simple terms, it means you will get paid to use your energy because you're helping out the grid. Octopus will send you alerts whenever the prices fall below zero, and you can take advantage of that. And looking at data, this data is slightly old, so take it with a pinch of salt, but the unit prices of energy between July 2020 and July 2021 dipped below 2p per kilowatt hour 163 times in that year. Now, they are going to be very small windows. It's not going to be all day. It's going to be for maybe 20 minutes, half an hour, maybe an hour here and there. But it shows that there are opportunities there if you engage with your energy usage and you have smart meters and smart devices for you to save some significant amounts of money on your energy bills.
So this is based upon supply and demand in the grid. So when demand starts to fall and isn't matching supply, this is where you get this plunge pricing when it becomes cheaper and actually the grid wants you to take the energy off their hands effectively in a roundabout way. You can get incredibly cheap energy and in some cases negatively priced, paid to use it. So that's interesting. And this tariff isn't new technically. It's been around for a while. It came to the fore last year.
Yeah, and so the way that it works is wholesale energy prices, they can be significantly cheaper outside of what you would call typical energy rush hours, which are typically between 6 in the morning and maybe 10 a.m. and then again from 4 p.m. to 7 p.m. So those people who can shift their energy usage so they're adaptable, maybe they've got certain devices at home that are smart and they can program to start at different times, they are the people that are going to be making the most of this. And even Octopus themselves say that this type of tariff is really aimed at those who engage with their energy, who have got smart devices, and even those who've got things like electric vehicles or even solar panels on the roof, so they can sort of adapt how they use their energy at different times. And obviously, the innovation of things like smart plugs, even if you haven't got smart devices, means that you can program certain things to happen at certain times.
So they actually have an API, don't they? So theoretically, Octopus can alert your smart plugs to turn on and start to use energy, so the device that they're attached to. So theoretically, this is a new smart world where you could start using energy when the price plunges. It seems to me, just thinking about it though, it is that manual combination that seems a bit better. If you're somebody probably who's at home fairly regularly throughout the day and there is a price plunge, you could put that load of washing on or charge something up that you will actually benefit. And in my head, it reminds me a lot of that kind of economy 7 style of energy tariff, but modern and more different, because where you were obviously charged more during peak hours and less off peak, this is you being able to choose when they are and reacting to live supply and demand and pricing in the UK. So this is like almost a modern take of it, which I think is incredibly interesting. But like you say, it's got to have a smart meter. And for the people who are able to be flexible with their energy uses, this might be of interest.
Yeah, and so talking about those figures and prices, people can be significantly better off. Recent data has suggested that people in the last few months, if they actively engage with this and use their energy outside of the busiest periods, they've been able to save up to 30% when compared to the energy price cap as it is. But remember, the energy price cap is changing again from the 1st of April, so those figures are going to be slightly different. And it is worth mentioning at this point as well that this particular tariff isn't protected by the energy price cap because it is a tariff where you sign up to a 12-month fixed contract. And the energy price cap is set to 100 pence per kilowatt hour, which is significantly more than the energy price cap. The good news, if you like, on that is there isn't any exit fee to come out of this. So if you go onto it and it doesn't work out for you, you can easily switch out. It might take up to a couple of weeks to come out of the fixed contract, but you'll then be moved on to whichever one you choose. And crucially, you can't then go back onto it again for at least 30 days. That's trying to stop people from trying to play the system and move on to it when they think it's going to be worthwhile and come off of it. So yeah, you just need to take those things into consideration.
So if anybody does go onto the tariff or has used it, I'd love to hear. So do write into the podcast, put it in the Facebook group if you want, facebook.com/groups/money to the masses. And also going forward, whether they will actually save much in comparison to the energy price cap now it's going to drop, which is a very good reminder because the price cap is dropping from the 1st of April. So if you're not on a smart meter where your readings are done automatically and are sent to your energy provider, it is worth doing a manual meter reading on the 1st of April to make sure that you get your energy charged at the correct price, especially when you go forward. So you don't want to get a bill where you're charged or estimated and most of it's on the old pricing. So make sure you do a meter reading on the 1st of April and then you submit that to your provider. In the past, when people have done this, there have been times when the sites have been a bit slow, but do bear with it. Take a photograph as evidence and make sure that you do submit it.
And so that is it. We are done for this week. We hope you're having a brilliant Easter break. We will see you on the other side. We've got another podcast coming up next week. Do make sure that you check out that video that we mentioned earlier on in the podcast, Best Stocks and Shares ISA. Don't forget to like and subscribe to the channel itself if you haven't done so already. This podcast itself does go out on the YouTube channel, so you can make comments on this podcast or other podcasts, and we will see those and we can react to those. If you've got any ideas for any future shows, we're always ears. And of course, we've got our Instagram, we've got our Facebook. You can join the Facebook group. There's been a lot of activity coming up to the end of the tax year. It's facebook.com/groups/money patreon.com/groups/money to the masses to get involved.
And of course, please do go and like the video, the best stocks and shares ISA video that has appeared on this particular podcast. Subscribe to the channel, but do like it, because that will help us grow our YouTube channel. Because going into the summer and the rest of 2024, I'm going to be doing even more on those channels. So it would really help us grow those channels if you do subscribe to them and like the videos, even if you don't watch them.
And so that is it. We are done for this week. Until next time.
Until next time.